Welcome to the deep dive. We're here to take complex, data-heavy stuff and, well, make sense of it for you. Today, we're plunging right into Bitcoin, that market famous globally for just extreme volatility, huge swings up and down. But what we found digging into the source material is pretty interesting. Beneath all that chaos, there seems to be this surprisingly reliable, defined time structure. We're talking about the 4-year halving cycles.
That really is the paradox, isn't it? If you're just watching the ticker day to day, it looks completely wild,
Yeah.
almost random. But you zoom out, and Bitcoin's big moves, they seem governed by this programmed rhythm, like a mechanical clock ticking underneath all the market noise.
Exactly. So our mission today is to give you that shortcut, that roadmap to understanding this rhythm. We've analyzed a whole load of historical data to document that really consistent 4-year pattern. It's quite astonishing, actually. But we're not just looking back. We need to figure out how the current cycle, the one we're in now, 2024 to 2028, how it's fundamentally, maybe even radically different. And it seems like it mostly comes down to one huge structural shift: institutionalization.
Right. And to get the pattern, you first need to get the core mechanism. The whole timing hinges on the halving. It's this programmed event, deflationary, written right into Bitcoin's code, happens about every 4 years, or more precisely, every 210,000 blocks that get mined. And it automatically cuts the reward miners get for adding blocks. It cuts it by 50%.
So it's deliberate scarcity, built right in. And that's what sets the timing for these cycles.
Precisely. It's not just, a little tweak to supply. It's a scheduled supply shock.
Yeah.
Non-negotiable. On a pretty fixed schedule.
Okay, so let's unpack this consistency you mentioned. It seems for over a decade now, Bitcoin cycles have shown this real temporal repetition. Our source analysis is super clear on this. 3 complete historical cycles, all lasting pretty much 4 years, and all tied intrinsically to that halving event. We're talking cycle 1, 2012 to 2016, cycle 2, 2016 to 2020, and cycle 3, 2020 to 2024.
Yeah, the consistency and duration is remarkable, especially for such a young, famously volatile asset. It gives analysts, investors, kind of a predictable framework. They know roughly when that supply shock hits, even if the exact price is anyone's guess.
Okay, but I have to push back a bit here. If it's a known 4-year pattern, isn't there a risk it just becomes a self-fulfilling prophecy? People selling in year 3, buying in year 1, just because they expect the pattern.
That's a totally fair question. And sure, market psychology plays a role. But the mechanism itself prevents it from being just that. The halving, it's hard-coded. It's not based on sentiment. Now, the exact date might shift a little because mining speed fluctuates, right? Block times aren't perfectly constant. But that 210,000 block count, that's the physical constraint. It creates a predictable, shrinking supply, digital scarcity. And that shrinking supply has to meet demand somewhere. Without that hard mechanical timer, I don't think the cycles would line up quite this neatly.
Okay, that makes the timing pretty compelling then. So duration stayed constant-ish, but the magnitude, the sheer scale of growth, that's changed dramatically cycle over cycle. It sort of tells a story of the market maturing, doesn't it? Let's look at those past cycles through the numbers, because some of them are, frankly, jaw-dropping.
We absolutely have to start with cycle 1, back in 2012. That was the real Wild West phase, just explosive. The halving hit November 28, 2012. Dropped the reward from 50 Bitcoin per block down to 25. And the price at that halving, around $10.50, $10.59.
Wait, hold on. $10.59. And then just 180 days after that halving, the price shoots from that $10.59 up to $126.24. That's what? Over 1,000% increase. 1,092% in 6 months. And the whole cycle saw gains over 7,000%. That's not maturation. That's a rocket strapped to a rocket.
Exactly. That first cycle was just pure exponential growth. Tiny market cap, extreme scarcity hitting a very small pool of early adopters. It was basically a liquidity desert. Any new demand set the price flying.
Okay, so if cycle 1 was the rocket launch, what about cycle 2 starting in 2016? Was that more grounded?
That's where you start seeing maturation kick in, yeah. The market was bigger, more liquid. The growth was still huge, obviously, but more tempered. The halving was July 9, 2016. Reward dropped to 12.5 BTC. Price then was around $650. The growth after that, about 294% in the next 12 months. Still amazing, but not 7,000%. And significantly, the inflation rate of Bitcoin dropped quite a bit then, from 8.7% down to 4.1%. That supply tightening was real, but the bigger market absorbed it differently.
Right. And then cycle 3 starting in 2020, that one really stands out because the growth, while high, seems so clearly tied to outside events.
Absolutely. That halving was May 11, 2020. Reward went down to 6.25 BTC. Price was hovering around $8,727. Now, the growth in the 12 months after that halving was 541%, a big jump up again from cycle 2. But it lined up almost perfectly with two massive external factors. Serious institutional interest starting to pour in and, well, all that expansive monetary policy globally during the pandemic. QE infinity, basically. It really proves that while the halving clock keeps ticking, the magnitude of the price move is super sensitive to macro conditions and global liquidity.
Okay, which brings us right up to today, the fourth halving, April 19th, 2024. Reward cut again from 6.25 BTC down to 3.125 BTC per block. And the data, the analysis we're looking at, it strongly suggests this current cycle, 2024-2028, is just radically altered. It's breaking the historical mold.
It really is. The sources pinpoint three huge differences. And the first one, well, it changed everything even before the halving happened, that is. Advanced institutional adoption.
Ah, okay. You mean the ETFs, the U.S. spot Bitcoin ETFs.
Exactly. Their approval in January 2024, just 3 months before the April halving, that was the watershed moment. It just blew the doors open for traditional finance capital. We're talking wealth managers, pension funds potentially, hedge funds, giving them easy, regulated access to Bitcoin.
And the key implication there, what the analysis shows, is that this access caused the price to shoot up before the supply cut even happened. We saw new all-time highs pre-halving. That's never happened before. It completely breaks the historical pattern.
That acceleration is the absolute core insight for understanding this cycle. The old story was always supply shock first. Halving happens, supply drops, then months later, price reacts. But now, the story is about demand front-loading. Institutions jumped in early. They bought anticipating the halving and maybe anticipating other institutions coming in through those shiny new ETFs. They effectively pulled the historical price reaction forward in time.
So wait, if the big players, the institutions, already bought ahead of time, that changes who's left to drive the price up later in the cycle, right? Which takes us to the second big difference. The change in the actual market structure.
Correct. When you bring in these big institutional players, these high liquidity actors, the market just gets deeper, more mature maybe. Volatility tends to get dampened somewhat because there's usually a big buyer or seller available to absorb large orders. But this improved liquidity, this is critical. It might also compress the time frames. Price movements can happen faster, even if the overall percentage gains aren't as astronomical as the early days. Things just move more efficiently.
And the third factor is something completely new for this cycle, something we haven't really seen discussed before in this context, geopolitics. Moving Bitcoin from just an investment towards potentially being a tool for governments.
That's exactly right. The source material brings up this new consideration, the potential for Bitcoin to be included in government strategic reserves.
Yeah.
The United States is specifically mentioned as a possibility. This is a totally novel variable compared to past cycles.
What does that even mean, though? A government holding Bitcoin like they hold gold? Why is that different from, say, BlackRock holding it?
It fundamentally shifts the perception, the utility, the whole narrative around the asset. I'm thinking about gold and reserves. It's not just about price appreciation. It's a hedge against global instability. It's collateral. It protects against their own currency potentially devaluing. If a major government like the U.S. starts treating Bitcoin even remotely like that, well, it institutionalizes it at the highest possible level. It potentially moves Bitcoin from being just another volatile asset class into being a factor in global macroeconomics. And that could influence the cycle, both the price peaks and the timing, in ways we're frankly just starting to try and model.
Wow. Okay, that is a paradigm shift. So we've got these powerful new forces, demand happening earlier, deeper liquidity, maybe even governments getting involved, all potentially squashing the timeline. So what's the projection now for the overall length of this cycle? Does the classic 4-year rule still hold? Or is time itself breaking down here?
Interestingly, most analysts cited in the source material still project the cycle will maintain that traditional 4-year duration. So running from the 2024 halving until the next expected one in roughly April 2028.
Yeah.
That 210,000 block mechanism, that hasn't changed. It's immutable code. However, like we discussed, the phases within that 4-year window look like they're getting compressed, mainly because of that accelerated start.
Okay, let's walk the listener through those forecasted internal phases then for this 2024-2028 cycle, because the timing within the cycle seems to be the key difference.
Right. So we kick off with phase 1, accumulation post-halving. This is projected to run roughly from April 2024, right after the halving, through about December 2024, so maybe 8 months or so. The thinking is this period is characterized by institutions consolidating positions, the market sort of digesting that initial halving shock and the big ETF inflows from earlier in the year, price stabilization, maybe some sideways action.
Okay, 8 months of accumulation, then we move into the main growth phase.
Yes. Phase 2, principal expansion. The forecast puts this from roughly January 2025 through November 2025, so about 11 months. This is where the models expect that aggressive growth, primarily fueled by continued institutional flows, to really kick in.
Hmm.
But notice how relatively short that phase is projected to be compared to previous cycles, which often had a much longer, more gradual build-up period. This suggests a faster, steeper climb.
Right, a compressed expansion. And after that, the peak, the climax of the cycle, that must be compressed too. Phase 3, distribution and maximums. When are they forecasting that?
That's the expectation, yeah. Based on analyzing these new variables and adjusting historical patterns, analysts are suggesting the peak period could be a remarkably tight window, maybe only 2 to 3 months, running somewhere between September 2025 and November 2025, a much sharper peak and distribution phase than we've perhaps seen before.
Okay, we have to talk numbers now. Price targets. With all this institutional backing, this accelerated, compressed cycle, what kind of targets are the analysts in the source material actually putting out there for the peak?
Well, they are certainly ambitious. Reflects the scale of capital that's come in and expected to continue. Bernstein analysts, for instance, are quoted projecting targets around $200,000 for 2025. The overall analysis seems to land on an adjusted range, maybe $150,000 to $200,000 is the potential high point for this cycle.
Hmm.
That's based on blending that deep institutional analysis with these modified historical cycle patterns.
150K to $200. Those are huge numbers. Obviously implies a lot of faith in continued institutional buying. But we absolutely need to pivot now and talk about the risks. What could actually derail this? What challenges could break that 4-year pattern, or at least seriously slash those price targets?
Yeah, absolutely critical to consider the counterarguments. The analysis highlights three main structural risks that could really throw a wrench in the works, especially given how much demand seems to have been pulled forward. First one, institutional saturation.
Meaning, if the big money got in early via the ETFs, who's left to buy and push the price up towards $200? Is that the idea?
That's the core question, exactly. If a huge chunk of institutional capital allocated quickly after the ETFs launched, and the pre-halving price action suggests a lot did, then it might significantly reduce the potential for that massive continued exponential growth we saw in past cycles. You need a constant, perhaps even growing stream of new large capital inflows to keep pushing the price up that steeply. What if the biggest wave has already hit?
Right, that makes sense. We might be trading some of that crazy upside potential for more stability, perhaps. Okay, what's the second major threat to the model?
Second big one is regulatory changes. And we're talking about significant new regulations going beyond just approving the ETFs. Imagine if governments introduced major restrictive rules, things like cracking down hard on decentralized mining globally, or maybe imposing really heavy tax burdens on holding digital assets. That kind of action could severely dampen enthusiasm, drive capital away, or just slow down adoption, impacting both the potential price peak and maybe even stretching out the cycle timing.
Okay, regulation is always a wild card. And the final risk mentioned.
The third one is competition. The crypto ecosystem isn't just Bitcoin anymore, is it? It's exploded. You've got all these alternative layer 1 blockchains, layer 2 scaling solutions, projects focused on real-world asset tokenization, sophisticated institutional DeFi. If capital starts flowing more heavily towards these other protocols because they offer compelling new use cases or maybe better risk-adjusted returns, it could pull investment away from Bitcoin. Bitcoin has historically captured the lion's share of new money coming into crypto, just by virtue of being the biggest and first. But this cycle, it might face real capital dilution from within the crypto space itself in a way it hasn't before.
So putting it all together, what's the big picture takeaway here? We've got this reliable 4-year timer, the halving ticking away, but the market engine running inside that timer, it's been fundamentally upgraded or at least changed and seems to be running faster.
I think that's a good way to put it. The central conclusion from the analysis is pretty clear. That temporal consistency, the 4-year rhythm, has been remarkable, a real testament to the power of that program scarcity. However, the actual nature of the market has evolved profoundly, mainly due to that institutional access. The fact that we hit new highs before this last Pura, having totally unprecedented, that strongly signals that while the 4-year clock might still hold for the overall cycle duration, the speed and efficiency within that cycle have increased dramatically. We seem to be hitting traditional cycle milestones much, much faster this time around.
Okay, so for you, the listener, here's the distilled takeaway. You should now have a solid grasp that Bitcoin's market rhythm, its heartbeat, is set by this mechanical clock, the halving. Happens roughly every 4 years. But the actual way the market behaves within that time frame, how money flows, when the big price moves happen, when the peaks might occur, that structure seems to be undergoing a radical shift, and it's driven primarily by this advanced institutional adoption and the resulting front-loading of demand we saw this time.
And of course, we have to reiterate the caution flags raised throughout the source analysis. Investing in assets like Bitcoin carries significant risks. These historical patterns, especially now, might not repeat perfectly or even closely in such a rapidly evolving market. All these projections we've discussed are based on available data and modeling, which are inherently speculative. Things can change fast.
Absolutely. Keep that context firmly in mind. So, with all that said, let's leave you with a final provocative thought to mull over. If institutional capital truly has the power to pull historical cycle milestones forward in time, like hitting new all-time highs before the halving even happened this cycle, does that inviolable 4-year cycle structure, the one that's held solid for over a decade, does it really remain untouchable? Or could the duration itself be the next historical pattern that eventually gets compressed by this accelerating market maturation and efficiency? Something to definitely think about as you watch this current cycle play out on the road to 2028.